What's going on, everybody? If you missed Jerome Powell's comments today in front of the Senate hearing, then you're going to want to see this video. He had some bearish things to say, which indicates that we may be headed towards a lengthened period of tightened conditions in the Federal Reserve's rate and in the real estate markets, as well as in the equity markets. Let's take a look at this video.
Well, more stimulus by federal spending is inflationary. Is that right?
It has so we've been in this situation where inflation was so stable for 25 years, you remember, and almost nothing that we did mattered for inflation. And it's called the so-called flat Phillips curve, where there just wasn't a connection between how tight the economy is and inflation. That does not appear to be the case right now. I think many people would say that the Phillips curve is now not so flat, and that there is an interaction between.
So that's a yes.
I think that's a yes. Yeah, it's
Okay.
This is economics,
And less spending by government it means less stimulus, which tends to be disinflationary. Is that fair?
Yes. Yes.
Okay. Let me ask you about.
So you can hear it right there in Powell's own words. Inflation was stable for about 25 years, and over the last few years, it has been ballooning. And what is that a result of? Well, our governmental spending went through the roof during the COVID pandemic. It doesn't really seem to matter who's in the office. We just keep spending money. And so if the government doesn't work to start to rein in their spending at some point in the near future, we're going to continue to see inflation high. And as a result, we're going to continue to see the Federal Reserve keep rates high. That's ultimately going to crush most assets, including equities like most stocks, especially the high-flying tech stocks that we've seen over the last few years, and real estate as well will be crushed. We really need to see the government rein in spending, but with a presidential election on the horizon, I don't see that happening anytime soon. Let's get back into the video with this next clip.
Bank. So my question is this: to what extent did the crash at Silicon Valley Bank, and to what extent does continuing concerns about stability in the banking area impact the decisions that you make going forward with respect to interest rates? How is that factoring in?
So there's pretty substantial research showing that when you have a shock to banking, like the one we had in March, to a sector of the banking industry, that if you come back in 6 months, you will see lower lending. And it doesn't appear immediately, but it's strong in the data. So we have been saying, we've been waiting to see that does play a part, at least in my thinking, that there may be a bit more tightening in the pipeline than there otherwise would have been. Now, we don't really see evidence of it yet, but then again, we wouldn't expect to see. But it all points to me in the same direction. We moved very, very quickly when we had to move quickly. We've been slowing down since last December, from 75 to 50 to 25 at every meeting. And now we're getting very close. We're at least close to where we think our destination is, where we think it is. And it only makes common sense to move at a careful pace. We don't want to do more than we have to, but we do think, overwhelmingly people on the committee do think that there's more rate hikes coming, but we want to make them at a pace that allows us to see incoming information so we make good decisions.
Thank you. Thank you.
So Powell said it right there. More rate hikes to be expected in the near future. Right now, the market is pricing in 0.25% rate hikes this year, but there is potential for more. As we all know, inflation can stay sticky for longer than expected. And if you look at the issues that the United States dealt with in the 1980s with inflation, there are many times where we thought we had it under control, but they had to continually raise rates to fight against the persistent inflation that was crushing the middle class. This had a severe impact on both equities and people's lives in general. Many people lost their jobs as a result. Stick around because there's more reasons why I think what Jerome Powell had to say today was super bearish.
For that.
And so then what are some risks if the FOMC continues to raise interest rates despite seeing the impact of these rate increases already resulting in more credit tightening and higher housing costs? And we talked a little bit about this.
So the risk is that the reason we've slowed down, really since last December, we slowed from 75 to 50 basis points per meeting to 25 at every meeting, And now, as we get closer and closer to what we believe will be it's uncertain, but we think our destinations, we've slowed down a little further. So we're trying to avoid the mistake of going too far. And that's all it is. And as you can see, overwhelmingly, people on the committee do believe that it will be appropriate to raise hikes 1 or 2 additional times. A strong majority believes 2 times this year if the economy performs as expected.
Thank you. And so let's.
So a significant majority of Federal Reserve members believe that we will have 2 more rate increases this year. If inflation continues to persist, we could see these rates stay high for an extended period of time, potentially through 2024. As I've mentioned previously, this will completely crush equities and severely hamper the housing market, both in residential and commercial. Obviously, this tightening has caused increased housing costs and has decreased access to capital. The purchasing power of those seeking out mortgages has diminished significantly. But I really think that this next clip is the most important.
But what's going to be the key determinant as to whether you raise rates or leave them where they're at? Or I don't think dropping them would be appropriate, but what are the things you're looking at to make those kind of decisions?
Well, I would say that if we see the economy performing about as we expect, then 2/3 of the committee really thought it would be appropriate to raise rates a couple of times between now and the end of the year. So what do we expect? We expect continued modest growth. We expect continued gradual cooling off of the labor market, gradual better alignment of supply and demand, and we expect inflation to be improving. And so if all those things happen, we think we're within a couple of rate hikes of the level we need to get to. We want to get to a level where we're confident that inflation is and will continue to is moving and will continue to move down to 2% over time. That's and not a higher level, that level. And so that's why we've slowed down here, as we think we are getting close to that level.
Okay, so let's think out past that. What factors are you going to look at that would determine a lowering in interest rates then?
So we don't see that happening anytime soon, and the test for that is that we're confident that inflation is moving back down to our 2% goal. We want to have some confidence. So, and I will say in the summary of economic projections that my participants and I filed last week, I think by the end of next year, by the end of 2024, the median participant did have some rate cuts. But that's going to depend on how the economy performs, and inflation has just consistently proven more persistent than we've expected and that other forecasters have expected. So it's going to have to await a time when we're confident that inflation is moving down to 2%.
So I want to talk about regulation.
So it seems to me like Jerome Powell and the rest of the Federal Reserve have pretty optimistic expectations as far as where inflation's going and what we're going to see here in the next few years. And if they really didn't have great expectations, would they really be so open about that? I think one of the really key portions of what Jerome Powell had to say today was about how they're seeking to bring inflation down to a 2% rate, not higher. That's going to require considerable effort on the Federal Reserve's part to keep interest rates high, to prevent any type of inflation pops in the near future. As he said, most Federal Reserve members do not see them lowering the rate anytime soon, and probably what we're going to see is rates stay at these levels or higher until the end of 2024. The Federal Reserve really needs to have confidence in their moves here because the impacts could be catastrophic. But the most important part was how Jerome Powell has stated that inflation has consistently been more persistent than they had expected. If that's the case, then we're going to continue to see high rates. And what does that mean? Well, I think that means that we'll see a significant correction in tech and AI stocks, as well as the broader market. If you haven't yet, check out my most recent video on how a bubble has been brewing in tech stocks due to large out-of-the-money call volumes that have been purchased on both tech stocks and the major indexes. Ultimately, I think that the next few years are going to be pretty brutal for both equities as well as real estate for the reasons that I've underlined here. And I think that Federal Reserve Chairman Powell's comments today really do underscore the bearish nature and the uncertainty that currently exists in our markets. I'd love to hear more about what you think. If you enjoyed the video, please give it a thumbs up and consider subscribing. I'll be covering more content similar in the future. Have a great day.